How to pick a stock to invest in. Finance for beginners. You've chosen to take the plunge and begin investing. You already know that investing in a firm with a low PE ratio, a company's cash on hand, is preferable to its debt, and those analyst recommendations should be taken with a grain of salt. You also know the golden rule of successful investors: spread your money around. That should be plenty to get you started. Whether or not you've already tackled the more advanced ideas of technical analysis, it's time to start investing in shares. Oh, but wait, how can you choose which few stocks to invest in when there are tens of thousands to choose from? Despite what some industry insiders may claim, it is impossible to analyze every company's financials to pick out the ones with a declining net debt ratio and rising net profit margins. Hello everyone, and welcome to another video on our channel. In today's video, we're going to discuss how to pick a stock to invest in. Finance for beginners. So stay tuned to find out. So let's start our video. Determine your goals. The first thing you need to do before selecting investments is to establish the goals of your portfolio. Making money is everyone's goal when they invest, but investors also often have other objectives, such as protecting their wealth, supplementing their income during retirement, or increasing their assets' value over time. Each of these objectives calls for a distinct approach to be taken. The diversified portfolio. Any of these sorts of investors could employ more than one of the tactics described above. This is one of the primary reasons why it is important to diversify. A moderate allocation of one's portfolio to growth equities is acceptable for even the most cautious investors. A risk-taking investor should set aside a portion of their capital to invest in reliable blue-chip firms to hedge against potential losses. The difficult thing is trying to figure out which category best fits you. It might be difficult to determine which stocks are the best to buy. Keep your eyes open. It is necessary to stay current on market news and viewpoints. A sort of research known as passive research includes reading financial news and staying current with industry blogs written by authors whose opinions you find interesting. A piece of writing from a news source or a blog might serve as the basis for an investing thesis. The argument that lies under the surface may be an obvious observation. For instance, you may observe that countries with expanding economies are giving rise to new middle classes, which are comprised of individuals with a higher need for a wider variety of consumer products. As a direct result, there will be a significant increase in the demand for various goods and commodities. If you're liking this content so far, please consider subscribing and liking this video. Now, let's continue. Find your companies. Choosing stocks includes locating potential firms to invest in next. One may accomplish this in 3 easy steps. Discover which exchange-traded funds or ETFs follow the performance of the sector you're interested in, and research the stocks they own. Conduct a web search for Industry X ETF to accomplish your goal. The top holdings of an ETF will be listed on the ETF's official page. Narrow down your stock choices by sector and industry with the help of a stock screener. Investment screeners provide consumers with extra options, such as the ability to filter stocks by market capitalization, dividend yield, and other relevant criteria. Scour the web for blogs, stock analysis articles, and financial news releases with information on the firms you've chosen to invest in. Always remember to think critically about what you read and consider alternative viewpoints. These 3 techniques aren't the only ones available, but they're a good place to start when deciding on a provider. In addition, each tactic has its own set of benefits and drawbacks that investors should weigh carefully before making a decision. Although researching news outlets for expert viewpoints is time-consuming, it may be fruitful. It's a great way to learn more about the basics of the business. It might also highlight underappreciated tiny firms that don't show up in stock screeners or ETF holdings. Tune in to corporate presentations. Once you've researched enough to ensure that the industry you're interested in is a safe bet and you know who the big players are, you can start looking at investor presentations. They are simpler to understand than 10Q and 10K reports and give a broad summary of how businesses generate revenue, but they fall short of the detail of financial statements. Forecasts for the future of the firm and the industry will also be included in these reports. You can narrow your options by seeing corporate presentations and browsing their websites. The procedure entails a deeper analysis of a firm in question to determine whether or not it has a better chance of outperforming its rivals in the market. Well, that's all for today's video. Tell us in the comment section how this video was. I hope that you found this one interesting. You can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.